All right, welcome to chapter 3. We're going to be talking about adjusting journal entries, adjusting for counts for financial statements. Before I begin, I do have my DECA background for you today. Consider joining DECA if you haven't already. It's a great organization for business majors, and we'd love to have you. But anyway, let's go ahead and get started in talking about adjusting for, uh, no, doing adjusting journal entries, excuse me. Let's go ahead and let's just jump right in. Let's talk about the accounting periods. So the time period assumption says that we can break up our accounting periods into various chunks. All right. So as you can see here, we have quarterly, monthly, semi-annually, and annually. More than likely, we're dealing with monthly, quarterly, and annually. I don't see a whole lot of people dealing with the semi-annual. So consider that. Our focus mainly in this course is monthly with the occasional quarterly or annually situations, okay? But that's the whole point of the time period assumption, is to be able to say that we're going to be able to break those up that way. So our financial statements are going to cover a period, and will depend on what period it is. So if it's a quarterly financial statement, it'll say first quarter, second quarter, third quarter, or fourth quarter. If it's monthly, it'll say monthly, or if it's your annual year, it'll be your annual. So the whole point of accounting and why we're grown up. All right, here we go. English major here. We grow up learning the cash basis of accounting. When you've lived your life, if you had a job and you earned money, if you got the paycheck within a certain calendar year, you would need to report that for tax purposes. It didn't matter if you got a paycheck, your last paycheck was like December 20th, and you got your next paycheck January 1st. That January 1st paycheck would not be on your W-2. But for accrual basis of accounting, we're going to have to account for all of that time period from January or December 20th all the way to December 31st of working, and be able to record that on behalf of the company. Okay. So revenues are recorded when products and services are delivered, and records expenses when we incur them. The way I like to explain that is more likely that you are going to have an accounting period that you're recording revenues when you earn them, and you're expensing your expenses in the time period you used them to help create those revenues. So that's what our accrual basis of accounting is and how we're going to look at it. So let's look at an example. If we had $100 of insurance expense, if let's see this, we paid $2,400 for 24 months of insurance on December 1st, 2021. So I don't know if you can see my mouse. Hopefully you can. But on December 21st, we're dealing with that $100 right there. Okay. If we're doing the cash basis, we would do 2,400 on December 1st in 2021, but we're not using that until the next 2 years also. So we can't expense it all in that first month or in that December month. So we have to spread it out using the accrual basis of accounting. So like I said, the cash basis of accounting, we put it all on December of 2021. Whereas I'm going back a slide here, the accrual basis of accounting lets us expense it as we use it. Because remember, let's say after December of 2021, if we decide to cancel that policy, looking at this strictly from the accounting perspective and not from the legal perspective and the fine print and all that crap, technically that company, that insurance company, would owe us the rest of that money, all of 2022 and 2023, we canceled that policy after a month. So that's why we can't expense it all in 2021. All right, recognition of revenues. Remember, whenever we provide the goods or services, we are owed that money, whether we've gotten the cash or not, we're recognizing it as revenue. Same thing with expenses. We are going to expense our expenses in the same accounting period we created those revenues. And it's whenever they've used, or we've used them. So we've got to make sure that they're put in the correct accounting period. All right. So we have 4 areas that we're going to focus on as far as adjustments go. We're going to look at deferral of expenses, revenues, and then accrual of expenses and revenues. So we're dealing with a lot of expenses and revenues. And our adjusting journal entries are going to only focus on two financial statements, balance sheet accounts and income statement accounts. So there is these steps, the adjustments made using these three steps. These steps are not necessarily accurate for every single one, okay? It depends on what the problem gives you. Sometimes the problem is going to say, this is what was used, at which point then that's your adjusting amount. But in the case of other accounts, such as supplies, we may have a situation where we're going to have a situation where it says you had X number of supplies at the beginning of the accounting period, and now at the end of that accounting period, you have Y. What's your adjusting journal entry? Well, you've got to expense the difference. So you're going to take the beginning, subtract out the ending, and get the amount that you used during that accounting period. That amount is what you're going to put as your adjusting journal entry to record that expense. So let's talk about, and we're going to go through these very specifically and individually. Prepare adjusting entries for the deferral of expenses. What does it mean to defer an expense? What it means is you're prepaying something. You're paying for something now, and you're deferring the expense. You're going to take it in another accounting period or at another time. So this is your prepaid accounts. We're going to talk about prepaid supplies. There's some other ones like when you purchase a piece of equipment, we're going to expense that over several accounting periods. And so that's technically considered a deferral of that expense. So because we can't, when we buy a piece of equipment or a vehicle, we can't expense it right away. We got to spread it out just like these other situations, okay? So what we're going to do to make the adjusting journal entry is we're going to debit the expense and we're going to credit whatever asset we need to adjust. Okay, so let's take an example here of that $2,400 of insurance. We paid 24 months that began on December 1st, 2021. So what we do is we're going to debit our prepaid insurance and we're going to credit our cash because we've prepaid it, meaning cash has gone out. So I have to drink too. So that is our journal entry that we would have done before. So here's your $2,400. That's what we paid, okay? But now we're going to have to expense this because we've gone through 1 month. It's now December 31st. So what we do is we take that $2,400 and divide it by 24 months, which is going to give us $100 per month. So what we need to do is reduce our prepaid insurance by 100, and we're going to increase our insurance, oh my goodness, insurance expense by $100. Okay, so let's show you this on the T accounts. So there's what we're going to do with this account. Our adjustment is going to be that $100, and now our balance in the prepaid account is $2,300, and that is our prepaid insurance is an asset. It's on the balance sheet. The insurance expense is an income statement account and is going to be put on the income statement. Okay. So here's our journal entry. We're basically, like we saw, we're going to be debiting the insurance expense and crediting the prepaid insurance. So there's our journal entry. All right, now let's look at supplies. So we had to do some calculations on this one, right? We had to take 2,400 divided by 100. In many cases, the book is going to have us do, we're going to be told $100 of insurance expense has expired. That's the same thing as we used it, okay? Expired use, same concept. Now in this situation, we're told we had $9,720 of supplies in December. Now, it could be that it says you have a beginning balance of something and you made purchases in the accounting period that totals something, and adding those together is what's available. So in this case, that available amount is the $9,720 of supplies. Then at the end of the month, we're going to send a intern or someone, kind of the low person on the totem pole, so to speak. They're going to have to go around and count up all the supplies and find out how much the value of those supplies are based on how much we paid for them. So for example, I have this Expo marker. If I had a bunch of these Expo markers, let's say it cost me $1 each, and I had 20 that I purchased. If If I only have 5 left over, then I used 15. I'm going to take those 15, multiply it by the $10 I paid for it, and come up with the fact that I owe, or that I used $15 worth of these supplies. So that's what we're doing here is we have a physical count at the December 31st date of $8,670. So what we need to do is we need to look at this from the T account form, and this is showing you something that I just don't like. Okay, the next slide is going to be kind of bad. You know what you should do here is you should draw a line under the 9720, and then underneath that as the ending balance is $8,670. From there, you got to figure out what do you have to do to go from a $9,720 debit balance to the $8,670 credit or debit balance. You're going down. So what we're going to do is we need to credit the supplies account for some amount. And if you subtract the 8,670 from the 9,720, you'll get an amount of $1,050. So here's your T account. This is that line I was telling you right under there that you should draw. Your balance is 8670. Subtracting the 8670 from the 9720 should give you $1,050. So we're going to debit our supplies expense to increase that account by the amount we used. And our credit will go to the supplies account, which is the balance sheet account. And then the supply expense is the income statement. Remember, the income statement accounts are always your expenses and revenues. So you can kind of figure that. All the other ones are going to be balance sheet accounts. Here's our journal entry to show the adjustment of that $10,000 or $1,050, debiting supplies expense, crediting supplies. Now, as promised, here is our depreciation we're going to talk about. Now, I didn't hide these slides. I'm going to just skip through them because I'm not asking you to calculate them, because that's accounting 112. We're going to do that in chapter 10 and learning how to calculate it. It's going to show you the straight line method. Don't worry about it. We're always going to give you in this course a question that says your depreciation expense was this. What do you do with it? Okay, so don't worry about all this. Okay, we're not caring about this. So they're calculating it, and it looks like based on this, our yearly, well, it goes over 60 months. So our monthly depreciation expense is $300. That's all you're going to be told in the questions. So what we're going to do is debit our depreciation expense, the amount, and credit what's called accumulated depreciation. And that accumulated depreciation is going to be tied to the equipment account as a contra asset account, because you notice accumulated depreciation is a credit, all right? And that increases that account, but it's tied to an asset account. And so whenever you have an account that is with the assets and has a credit balance, it's going to be a contra asset account. Just means that it's going opposite of what the normal rules are for that account. Instead of the normal balance being a debit for asset accounts, it's a credit. No big deal. Anyway, we're going to debit our depreciation expense for $300 and credit the accumulated depreciation for the same amount. Now, interestingly enough, on the balance sheet, you're going to present it like this. Your equipment's going to be that 2,600? Yeah, 26,000. And then it's going to show how much accumulated depreciation you have against that account. In this case, we calculated $300 as our monthly amount. So we see that this is about 3 months worth. So it's probably a quarter. And it's going to show the less accumulated depreciation. And it's going to show you what the book value is. The book value is at $25,100. That's all you need to really worry about here. Nothing big, nothing to worry about. Again, for purposes of accounting 111, all you're going to need to know is depreciation expense was $300. What's your journal entry? You debit depreciation expense $300. You credit accumulated depreciation for $300. You're done. Okay. Adjusting entries for the deferral of revenues. All right. So what is a deferral of revenues? What it is you're receiving money ahead of time for work you're planning on doing but haven't done yet. So you're recording what's called unearned revenues. So unearned revenues, we're going to record as a liability. When we first get it, we're going to be crediting the liability account and debiting cash because we're receiving it in advance. Then, once we do the work or provide the goods that we're promising, we're going to debit that unearned account and credit the revenue account. So let's have a look at this. We received a client paid us a 60-day fee in advance, covering December 27th through February 24th. So what are we doing at the end of that month? Well, in this case, they want to show that we're taking the $3,000 that I guess we got paid. Oh, and here's our receiving of it. Step one, we received it, debiting cash 3,000, crediting unearned revenue 3,000. We're receiving advance payments for the services. We're going to take that 3,000. You can do one of two things. It's 5 days out of 60. You can take that ratio and multiply that by 3,000, or just take the 3,000 divided by 60 and then multiply it by 5. Either way, you're going to get it there to the right number. Doesn't matter which way you do it. Thank you, transitive property, I think is what it's called in math. We can do it either way. So as a result, we are going to have a $250 adjustment here representing the amount of money we've earned. Okay. So we've had this unearned consulting revenue, which is a liability. So we're going to need to debit that account and credit our consulting revenue, as you can see in the T accounts here. Unearned consulting revenue is our balance sheet account, and the consulting revenue is the income statement account. So now on this slide here, we see that our income statement, our consulting revenue account has about $6,050 in it. And then our ending balance of our unearned revenue account, or unearned consulting revenue, is $2,750. Forgive me for the yawn. There you have it. All right. Here's our journal entry. We're debiting our unearned consulting revenue, our liability account, and we're crediting our revenue account because we earned it. We worked for those days. We're now entitled to that money. And again, if you have any questions on any of these, I'm going through these slides and I'm explaining it in my terms. Sometimes these slides have notes that you can review and look at. That's fine. Go ahead and look at those. And if that helps, great. If you still have some questions after this, which I'd be surprised if you don't. I'm sorry to say this at this point. I can't remember if I said at the beginning of the video, but this chapter is a hard chapter. Okay, it's trying to rewire your brain into thinking a different way. Again, we've talked about we've lived in the cash basis. I'm asking you to think a little differently now, so it can be confusing. The best way to break that confusion is just working some problems and thinking logically about it from the corporate standpoint. Okay, and so that might be a little harder to do, might take some training, but either way, we'll get you there. Now, accrued expenses are expenses that we have incurred but we haven't paid yet. So it's kind of the opposite of prepaying our expenses like we did before. Now we're incurring a liability that we haven't paid for. And in many cases, an example of this is utilities or salaries. All right, when an employee works a certain time period, if that time period overlaps an accounting period, right? You work 2 weeks, you get paid on the third week, right? So if the fiscal year or the quarter or whatever the accounting period is ends somewhere in between during that 2 weeks, whatever those employees worked up until the end of that accounting period, we just got to record that as an expense, and then we've got to record it as a liability because we're showing that we owe it. Okay, and that's what this slide is showing you, that we're going to incur a liability as a credit and debit the expense. Here's our example. Fast Forward pays its employees $70 per day, which equals oh man, Brian, stop yawning. $350 for a day, 5-day work week. And I'm sorry I'm yawning because you guys are probably tired and trying to watch this, and I'm yawning too. It's probably not very helpful, so I apologize. Salaries are paid every 2 weeks on Friday. So every 2 weeks they get paid $350 for a 5-day work week. Multiply that by 2. If it's a full week, there you go. But in step 2, it looks like December 31st is a Wednesday. So 3 days salaries are owed at the end of the year, which equals $70 times 3 days. So each employee is $210 that we owe them per that time period. Now, it looks like we only have one employee is what they're going to say. But if we had 5 employees, we'd take that 210 and multiply it by 5. No big deal. But in this case, we have one employee. So what we got to do is we got to expense that time we used of that employee and put it as a salaries payable of $210. And here's our journal entry. We're debiting the salaries expense $210, and we're crediting the salaries payable for 210. Sorry, I should just click through this so you can see them all first instead of talking about it. Salaries payable, that's your liability. It's on the balance sheet. Salaries expense, expenses and revenues are on the income statement. Okay. All right, and there's your total yet. All right, so now when we go to pay them in the new accounting period, what we're going to do is we are going to pay them the remaining amount, the $490. We take the 7 days times the $70 rate for $490. We got to reduce then the liability we just created back here for salaries payable. We got to reduce that. So we're going to debit salaries payable for 210 and then pay them their normal amount of $700 for those weeks, those 2 weeks that they got, that they worked. All right, the last area is going to be the accrued revenue section. Now, what accrued revenues are is revenues that we've realized that we've earned, but we haven't yet received payment for. So we're going to increase our revenues and we're going to increase our assets, but our asset is not cash, all right? Our asset's going to be accounts receivable. So in this case, fast forward, customers agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. What do? Take 2,700 divided by 30 and multiply it by the number of days in this accounting period. In this case, it's 20 days. We count 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So we're at 21 with 10 days. 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 20 days. So you can take 2,700 divided by 30 and multiply it by 20, or take 20 divided by 30 multiplied by $2,700. You're going to get the same amount, 1,800. All right. So what we're going to do is we're going to record the revenue, credit it for 1,800, and then we're going to debit accounts receivable. We haven't got the money yet, so we've got to show that we are owed $1,800. But notice, all because we didn't get the cash, we still record the revenue. We earned it. It's revenue, whether we get the cash or not. Okay, so accounts receivables are balance sheet in the asset section. Consulting revenue is a revenue in the income statement. Then when we get paid at that later time, we're going to go ahead and show that, you know, we've worked 10 more days and then we're going to get paid. So cash is going to go up $2,700 with the debit. We're going to reduce the accounts receivable that we recorded from the last accounting period. So we're going to reduce that by 1,800. And then our consulting revenue for the 10 days we worked in January is going to go and increase our revenue account by $900. So here's a good slide to look at if you're getting a little confused or whatever. Deferrals and accruals, go ahead and look at this, kind of, you know, make sure you keep that in mind. It's not a bad slide to have, especially what adjusting entry you need to do. It will help. It will help. All right, prepare financial statements from the adjusted trial balance. It's very similar to preparing the financial statement from the unadjusted trial balance. It's just that a lot of your accounts have changed now. The only one I want to point out that hasn't changed is the cash account. Notice that we did not adjust cash. We never adjust cash. We never close cash. So once you're done with cash from the first unadjusted trial balance, you're never touching that cash account again, all right? Because you're never closing it. So keep that in mind. Bear that in mind. So we had our unadjusted trial balance. Unadjusted trial balance here. We have our adjustments that we made just now, and now we have our adjusted trial balance. We're going to make this the same way. We just have these new amounts. We're going to start off with our expenses, which are always listed last in the 600 section. Then our revenues, which is our 400. So revenues minus expenses, that's our income statement. Then we're going to deal with our capital accounts, which are the 300 accounts. We got our Taylor capital plus our net income that we calculated from the income statement minus the withdrawals will give us our ending balance on the equity account. Then we're just going to list on the balance sheet our assets, our liabilities, and then what the remaining amount is on our capital from the statement of owner's equity. Okay. Now keep in mind there is a cash flow statement. I don't teach it in this class. It is a financial statement, and you will learn it in Accounting 112. I think, I've heard that people yawn because they lose air in their system, and a yawn is like you got to breathe it in, and so I guess when people are tired, they're not breathing as deeply and stuff like that. So it's not like I'm tired, so I really do apologize. But I think now is a really good time to give you your word. Your word is download. 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 One word. Download. Download. All right. So steps for preparing the financial statements from an adjusted trial balance. I've already gone over that. So if you have any questions, let me know. Here's how you do it. You can pause this slide, kind of spend your time looking at it. It's important to realize how it's all made from this. So pause this if you need to kind of really internalize this. We're not going to do this. So let's just skip the computing these, although it's not a bad thing to learn this. Profit margin simply equals net income divided by net sales. Yeah, we're not going to do alternative accounting for prepayments. I'm not getting into that. I'm also not going to get into reversing entries, which I think is no. All right, it's not on this. I think it's actually chapter 4 after we close. I'm not going to do that either. So that's chapter 3. I hope you enjoyed it. If you did, my name is Brian Smith. I'm an accounting professor at South Mountain Community College. If you didn't, then I was gonna say one of my friends at another college. Never mind, I won't do that. It's anyway. But yeah, I hope you enjoyed it. If you have any questions, please reach out. This is a hard concept to understand. I understand that, but I want you to be successful. So please, if any questions, come bring them my way, and let's learn this together. Hope you have a great day.